Right, now let's talk to GCP. So if we could bring on Ed. Good morning, Ed.
Good morning, James. Thanks for that, Andrew. Thanks very much for the very helpful lead into this. Good morning, everyone. I'm going to talk this morning about the proposed combination between GCP Infrastructure and GCP Asset-Backed Income Funds. Excuse me, I apologise. I've got a bit of a cough, but I also mentioned the ongoing discussions with RM Infrastructure. Obviously, the warnings. I put this slide in just so you can see a tiny picture of who I am. I don't like the large mugshot with my big shiny head, but that's me in the middle of the screen.
I'm afraid that's in the pack later on.
Oh, that's no good. So that's me. My name's Ed Simpson. I've actually been at Gravis since January as head of energy and infrastructure, but I'm also working very closely with Phil Kent, who's the chief exec and the lead portfolio manager on both of GCP Infra and Gabi. This really just highlights that we have a large team that's already focused and dedicated on managing the investments in these funds. We could go to the next slide. Thank you. This is really just to give a bit of context on the GCP Infrastructure Portfolio. GCP Infrastructure has been going 13 years now. It already has a very mature and a diverse portfolio of UK infrastructure assets. The sector and analysis are shown in the pie chart. I think the key things to pull out from this is we've always focused on diversification. So we've got diversification across asset types and across sectors. So we've got PPP assets. We've got about 23% renewables, 67%, and 10% social housing, which is all supported living. The diversification for us has been absolutely key. And I can talk that a bit further into the presentation. It's also worth pointing out that whilst GCP was set up before ESG was really a thing, all of these assets actually make a positive sustainability impact, either social or environmental. And we think that the positioning of these assets will provide really strong support for the returns on an ongoing basis. I can flick to Gabi now. So this is the Gabi portfolio. Again, here, it's worth highlighting that we have diversification across, this time, 59 investments. So I didn't highlight on the chart before, but in infra, we've got 47% in inflation protection. In Gabi, we've got 53.5% inflation or interest rate protection. So again, this really shows that despite the headwinds in the macro market, the increasing inflation, we are to an extent covered against the increase in inflation. It's also worth highlighting that whilst the assets, the sectors are different to GCPs, they're actually very complementary and also positioned to benefit from macro trends of population dynamics, decarbonisation, and energy security. So excuse me. Again, we think these are very complementary portfolios, and similar to GCP, we're focused here on debt. In Gabi, 71% senior and 29% as subordinated loans. The key thing, I think, really for GCP to highlight here is that the weighted average remaining life of the loans is 5 years. That compares to the 10-year weighted average loan life for GCP Infra. So again, I'll talk the benefits of the combination further down. If we could go to the next slide, Andrew's very kindly given some discussion on the macro background and the headwinds that have gone, which we believe, too far. Obviously, our focus at Gravis is in managing the investment companies and making sure that the NAV and the returns are as strong as possible. But obviously, we operate within the wider market. So I thought it worthwhile just pulling out a few of these charts. So if we start from the left, this shows the interest rate environment from when the investment companies were launched. So we've got 8 in the case of GCP, 8.44% weighted average returns on or yields on the loans. Those loans were made during periods of very low interest rates. As the credit market has reset in the last year, you see the significant increase in base rates. It's understandable that investors will also look for yield elsewhere, and the relative attractiveness of the yields on GCP and Gabi have become less attractive given the high yields available on government on gilts and other fixed income. However, that also means that the investment opportunities in front of us have also increased. So there are some very attractive investment opportunities in the market right now where both GCP and Gabi can be investing funds at higher rates. Although given this, the increase in yields, I think both boards have been very clear that the focus right now is on de-gearing. And that leads to the second chart, which does show that both GCP and Gabi have traded at a significant discount over the last 12 months, and that's pretty new for both companies. As I said, we've been focused on the strengths of the underlying portfolios and focus on de-gearing, but it's clear that there is a big discount, and we and the independent boards have been talking to investors and looking for trying to find ways to support our shareholders. Then I guess going even more macro into the third chart, this really for me is why we've focused on diversification in the funds. When these funds were launched, infrastructure as an asset class was relatively new. The yields available were very attractive. I remember when I first looked at my first wind turbine investment opportunity. So back in about 2007, 2008, and we were looking at a 12% ungeared IRR. Now, as Andrew was saying when he was looking at some of the investment trusts, investment companies that have focused on purely on renewables, I think any of those funds would bite somebody's arm off to get ungeared yields like that now. So that's partly because the sectors themselves have become established. So the risks are better understood, and so the risk premium is not required so much. But it's also been as a result of more and more capital being raised in the sectors, and so there's more capital looking for investment opportunities, and therefore the price goes up, the yield comes down, and that's why both GCP and Gabi have been focused on the diversification, not being stuck in a single sector, where as capital is raised, the yield available for investors has gone down. It's also worth highlighting that the government has changed its approach to subsidies. Back in the day, the PFI, PPP world, and even to an extent with ROCs and feed-in tariffs on renewables, the government was making very clear and explicit subsidy support and revenue support for new infrastructure assets. The government, and I think everybody recognises, there's a significant need for investment in new sustainable assets that will support the decarbonisation of the UK economy. But the government is no longer doing it through direct subsidy support. It's doing it in other ways to support and create markets. So again, that creates opportunities for both GCP and Gabi to find new and attractive investment opportunities. The final chart on the right is again to highlight that or to recognise that many of the there's been significant consolidation in the wealth management sector. That has meant really that the lots of the investors in our funds and in other investment companies and investment trusts are looking to have investees looking for target companies like ours that have the scale, that give them the liquidity and the scale where they can deploy funds. So again, that's one of the drivers we think for ensuring that we have investment companies that are at scale for the investors that we desire. That then leads very nicely into, well, why have the boards of Gabi and GCP Infra proposed the combination? Obviously, highlight this is very much, these are proposals, they're subject to shareholder approval. It's obviously something that Gravis recommends. We think it is in the best interests of each set of shareholders as a whole. We can see some very attractive reasons for it, and I'll highlight these now. So what exactly are we talking about? It's a combination of GCP and Gabi that will give a sizable debt investor in the infrastructure and real asset sector, with a focus on, as we have naturally developed, to focus on sustainability, where we think there's some real tailwinds to support both new investment opportunities and also support the value and the ability for the underlying borrowers to both grow and service the debts that we provide them. Through the combination, we're proposing to create a liquidity pool or de-gearing for shareholders. So that would be 100 million of de-gearing, so reducing the RCFs that both companies currently have. The expectation is to do that well within 2 years, and return another 200 million of capital to shareholders in the 2 years post completion, and that would be through a combination of buybacks, tender offers, or otherwise, in order to get the liquidity for shareholders. As I've highlighted, in order to do this transaction, and also to recognise the changes that have occurred to the infrastructure market over the last 13 years, we're looking to reposition the enlarged GCP mandate, and that will bring a focus on sustainability. It will also recognise that there will be no new, or right now we can't see any new material directly government supported revenues, but there are opportunities where there is the government is creating a market, and where revenues are highly predictable on real assets. We're also proposing to introduce a continuation vote, which neither company has right now. So this would be again to give shareholders the ability to review the ongoing operations of the business in a formalized way, and finally to recognise that bringing GCP and Gabi together will hopefully have some economies of scale. Well, we know it will have significant economies of scale in the removal of certain overheads that are currently duplicated. So we won't need 2 boards, 2 administrators, etc. Gravis has also agreed to reduce its fees on the assets on the NAV over 1.3 billion. Hopefully, I've kind of highlighted some of the rationale benefits as I've been going through, but again, just to reiterate, we think the increased scale and liquidity is going to be helpful for shareholders. By combining it, we will have a faster capital reallocation. As I highlighted before, GCP has a 10-year weighted average loan life. Gabi has 5-year weighted average loan life. So by combining the two, we'll be able to reset the investments. So we'll be able to provide the 200 million liquidity and de-gearing that I've just highlighted, but there'll also be the opportunity to reset the investments, where maybe 12 months ago we'd be potentially on a competitive basis being able to lend at 7 or 8% on an investment opportunity. We're already seeing that those opportunities have been reset, and so for exactly the same risk, the same opportunity, would be able to be lending in at significantly higher than 8%. So the combination of GCP and Gabi will allow faster reallocation, resetting, and hopefully bringing up the weighted average yields on the investments as the whole. And I've talked about the mandate. I think finally, just to highlight, is we have here. I'm not going to talk about it because it is still in due diligence by the GCP board, but we're also still talking to RMI. So after proposals, what does that mean for the long term? With the scale and the provision of liquidity, we've been talking to shareholders and the board's advisors have been talking to shareholders and understood that liquidity has been important. So the first thing we will do is meeting those liquidity commitments. So that is the commitment to de-gearing and returning at least 100 million more to our shareholders. In the medium term, we will then be able to reset the portfolio, as I've just discussed. Will be bigger scale, so that will hopefully give shareholders greater liquidity in the share pool, and we will continue to have a pool of very attractive UK investment opportunities. So I've highlighted the three sectors that both, or three themes that both companies benefit from. Decarbonisation, so that's the transition to net zero. We've already got exposure to renewables and some transport, but there's industrial decarbonisation, there's natural capital markets, there's heat transport and wider energy transition, all of which will provide very significant investment opportunities in the years to come. Similarly, population change, there's going to be continued need for social infrastructures, housing, healthcare, education. There has been private provision of healthcare leisure before. We have highlighted that neither fund is looking to make further investment in supported living, but there will be opportunities in other areas. And then finally, again, some significant investment opportunities in infrastructure renewal to extend the life of the assets. We could go to the next slide. Thank you. So we believe that the combination will provide or produce a leading real infrastructure and real asset debt investment company. The consolidation, we think, will produce the scale that investors want. It will allow us to provide significant cash back to shareholders, whilst also building a company that will have very attractive investment opportunities for the long term going forward. If I could go to the final slide. I won't read through all of these. I'm hoping I've highlighted everything so far. I think the one which I haven't specifically pulled out is the share register. So there is significant crossover in share registers, so we believe that a combination should benefit that. I haven't mentioned cost optimizations, so the removal of certain fixed costs has been estimated to make an 800,000 benefit for the companies on an ongoing basis. There's also the fee reduction. So recognizing that as the companies return to growth, there will be the costs, investment advisor costs will have a tiered fee. And finally, Gravis has agreed to make a contribution towards the costs of this transaction of £1 million. That is me. So I think it's over to you, James.
Thanks, Ed. That's really helpful. First question on the list then, Ed, why is there no immediate cash exit opportunity?
As in
terms of the combination. So it's common sometimes to include a kind of like, 20%, 10% cash alternative. So
I can't talk to how the board's negotiated this. I think it's a couple of things to highlight is Gravis is obviously a service provider to both funds, and we recognise we believe it is very attractive to the shareholders as a whole. But it's the boards and particularly the chairs that have been leading the negotiations or conducting the negotiations with their independent advisors as to the terms of the deal. So I think so I can't comment on the terms. I would highlight that the liquidation pool, the de-gearing and the 100 million return to shareholders over the next 2 years is a commitment that will be providing cash in the short to medium term.
I suppose you just don't have cash on hand, to be fair, to fund that.
No, both companies have RCFs, and whilst both have committed since the June quarter ends, both companies have announced and committed that we're looking to reduce gearing, given the benefits of having the RCFs are less now that the base rates have gone up. So the cash that is being generated in the short term, the boards have committed to be reducing gearing, and that's been shown even before this was announced in GCP. We've been significantly reducing the gearing and have made, I think it was only 1.7 million of new investments in the last quarter. So the focus of the cash in the short term that we've been doing has been to reduce the gearing.
Fair enough. I suppose then you probably can't talk to this question, but do you know how the board is going to prioritise what it does with the cash that gets freed up over the first couple of years? Yes,
I think I can say, I hope we've been reasonably clear. The very first thing we'll do, the very first de-gearing that will happen is as GCP takes on, or it will have to increase its gearing in order to pay off the RCF at Gabi. The very first cash will be used then to pay that back down again. So the focus very much is on de-gearing in the short term. Any investment, I think after the initial de-gearing from the transaction, any new investment, as we've highlighted before, will have a very high bar. The market right now is that we should be making new investments at some very attractive rates, but right now, given the cost of debt, it's very clear that there's a high bar for new investments, and de-gearing and share buybacks are very attractive investment opportunities in their own right.
Okay, thank you. You talked about them having sort of similar asset bases, but there are differences between the two. Are there bits of Gabi's portfolio that won't stick around once the transition is complete?
So I can't talk to that because it's still finally to be determined. But I think with the refocus mandate, there are some assets which I think would be considered less core, and those would be. I don't think there would be an intention to try and dispose of anything, but I think there are some loans that we would let go into runoff and just be repaid to term, and we wouldn't extend further.
Okay, thank you. There are some assets within Gabby's portfolio. I mean, it's not a huge amount, but nevertheless, there are some where they've sort of been problematic. So how are those going to be dealt with when the merger happens?
So I think there's a couple of things to highlight. First of all, the combination has been proposed on a formula asset value to formula asset value ratio. So it will be driven by the valuation of the assets. The assets for both companies are determined independently by Mazars, who are a very well recognized and very experienced business that has what's in accountancy, and I'm not sure how they're all described nowadays, but the team at Mazars are expert valuation agents, and they run the valuation entirely at arm's length basis on both GCP and Infra on a quarterly basis. So any assets that have had issues, those issues will have been reviewed over multiple quarters already by Mazars, and the expected cash flows and the risks to those cash flows will already be included in the NAV. So on a valuation basis, we rely, and the board relies on the independent valuation agents rather than Gravis. So on the valuation basis, that's determined. I think on the management of those assets, I think if things aren't going exactly to plan, that's when you need extra management time. And I just kind of remind you of the first slide. We've already got teams that are managing all the assets in the portfolio already, so there will be no change there.
Okay, thank you. And so in terms of GCP investors, is it fair to say that one of the big benefits of this is this accelerated liquidity that comes from Gabby that enables you to do things with GCP's portfolio and accelerate buybacks and things that you wouldn't be able to do otherwise?
I think that's it. There are, I think, lots of benefits for GCP, but yes, one of the key things is the shorter duration of the portfolio. So that allows both the liquidity offer of the de-gearing and the return of capital, or it will help facilitate that, and that comes from the relatively shorter weighted average loan life.
Yeah. Okay. Thank you. This question here. So obviously, in inflation protection, you highlighted these numbers. Where does that come from? The inflation linkage.
So it comes in a couple of ways. There can be there's a direct inflation linkage in some, where the interest rate on the loan has a ratchet. So as the inflation goes up, so does to an extent the cost of the debt for the borrower. So that's a direct one. In certain loans, it's a slightly different process. On an annual basis, we look at look back at the inflation, and there's an adjustment to the principal. So instead of increasing the interest rate, there's an increase to the principal. So the interest rate stays the same, but the principal itself increases.
Okay, thank you. Once you sort of work through the liquidity thing, and we're looking at making new investments again, where do you think the focus of those is going to be? Obviously, there's been a big shift towards renewables over time. Is that going to be an increasing portion, do you think, given where you think that the opportunities are in the future?
I think there's going to be opportunities across the board, actually, and that's why I actually think it's a really attractive and interesting time. It's whilst the repricing of the credit markets, I think, will allow us to do to make loans at similar levels of risk, but at increased rates of return. But actually, yeah, it's exactly that chart you've pulled up. I think there's some very attractive infrastructure and real asset opportunities across the board where we'll be able to lend in to some real assets which have got really predictable long-term cash flows. So yes, decarbonisation has been, and I think will be, probably the major theme. However, as I highlighted, it's not going to be necessarily just pure renewables. There are lots of funds aiming at just renewables. And the reason we think that GCP Infra has been able to maintain its dividend for such a long time is when a new infrastructure theme is developing, the risk is not necessarily as well understood. So we focus on debt, but we try and get into newer areas where the risk is not necessarily so well understood, so it's not so competitively priced. So we think there's an opportunity to lend at higher rates. As I showed earlier, and as I mentioned, a pure say, a wind project, I used to be able to buy it, double-digit, low-teen, ungeared equity returns. That's just not available. And with the wall of money into some of the more traditional themes, I think the competition for those assets means that the prices will go up, the yields will come down, and I think you'll need to start making different assumptions on life extensions, etc. Whereas we'd rather be looking at some potentially new areas that are being supported again by government and where they're creating opportunities. One I think an example could be renewable transport fuel obligation. That's not a direct government subsidy, but it's creating an obligation on producers of fuel to put an increasing amount of renewable fuels into the fuel that they supply. So it's not a direct subsidy, but if you can be producing that fuel, you know that there's a government mandated market for that product. So I think there will be some new areas like that will be developing and will be ongoing areas of investment for us.
Okay, probably one last question. Can you just to probably clarification, really, there's no intention to change the dividend on GCP, is there?
I'm not sure if that's been announced. I'm sorry. I'm conscious that we're in the process of working with reporting accountants and things. I think we have said that the expectation is that the Gabi will improve the existing dividend cover for GCP Infra. And I think we also talk about the investment strategy being long-term sustainable dividends. So I'm not sure whether I can or should say if there's been a policy announced, because I'm afraid I'm not sure if there has been a change.
Yeah, it's really a question for the board, I think. So
but it's long. We have said the dividend policy will be long-term sustainable dividends, and the 7p we've got has been sustained so far.
So timing-wise, when are we looking at seeing some documents on that, do you think?
I had an updated timetable sent to me this week. I think the intention is that it would be we're working on the various documents with the FCA, or to get approval from the FCA. The London Stock Exchange, and we will be getting things out in due course. But so they are actively being worked on, but I'm not sure we've got a finite a fine timetable for that, but it's something that we're working on as quickly as we can.
We'll look out for them. So thank you very much indeed, and we'll follow with interest, and I'll send you follow-up questions if we've got any. That's all right.
Brilliant. Thank you very much.
Thank you. So thanks everybody for listening today. We'll be back next week. I'll be back next week talking to Prashant Kemkar of Ashoka White Oaks Emerging Markets, which is the newest fund that we've got in the sector. And then you see we've got a fairly full slate there running all the way up till the end of October. I think we might have somebody even for the 6th of October lined up. We'll have to wait and see what the emails have been flying around while we've been having this presentation. So thank you very much again for listening in. Thank you for Matthew for doing it last week and the week before when I was off ill and then on holiday. And I'll see you next week. Bye-bye.